Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is January 11th edition of Market Outlook 2015. And Happy New Year, and welcome to incredible market volatility. So let's get into this week's video. We got a couple of interesting things to point out, especially gold and some of the volatility. Let's take a look. For one, take a look at the spiders. First, we closed under the 50-day moving average one day. If we can penetrate the low from Friday's action and the 50-day moving average, the market could be in for some additional trouble. First level of support would be around the 200 level, and beyond that around 196. Now, alternatively, if we can swing above and take out the highs from Friday, we would be back into a bullish phase with a rising 50-day moving average. So you can see here, these three red lines here show increased volume on down days. There was only one day last week, last Thursday, where you actually had a marginal accumulation day, but definitely shows some distribution up here at these levels. So the market shifting on a dime here and really following that short-term action. But you have a really good play here following the action down if it breaks that low from Friday, and alternatively, if it takes out the highs from Friday, that looks pretty good to the upside. Let's take a look at the calendar range. The 6-month calendar range has not been put in yet, but the one day, the first calendar day of the year, also coincides with those highs. So from Friday, so really a little bit higher would take out the calendar range somewhere. Let's see here, the one day somewhere around 207 would be a critical level in the spiders. Now, going back here to the QQQ, a little bit more troublesome because you can see here that we definitely that 10-day moving average crossed under the 50, and we were not able to take out the recent highs on the rally, which the spiders were able. Now, we pointed that out as a point of contention and concern. So that yellow flag is still up, and we really want to see that take out the all-time highs, which again is a good 3-4% from here, but worthy of waiting to get a real confirmation that the leading NASDAQ stocks will resume its leadership. And again, I wanted to point out Goog, right, really closing under 500. That's sort of a psychologically important level. Also, from the lows last May, you can see we basically closed under that for the first time in a convincing fashion. In addition, you can see we were stopped on the recent rally at the end of December, right at the 50-day moving average. Markets rolled over, so definitely want to watch this because you've had quite a bit of work. You can see this potential top forming here, and this was an important gap on this particular October breakout in 2013. So not good price action in a formally leading stock. Similar with Amazon, we took out 300. Again, not quite as critical, but look how this thing is potentially tracing at a top. Critical level in Amazon is around the 285 to the 280 level. But again, that would potentially show a drop of about 80 points, possibly down to 200 in the event that we get a serious downturn. These two NASDAQ stocks clearly showing some relative weakness. Let's take a look at some of the market internals. Volatility. This is the spread between short and long-term volatility. You can see we reached overbought levels here. This red line here is the ratio. This is overbought. That's oversold. So we got a little bit oversold. This is on a half-hour basis. A little bit oversold on the short term. Hence, we got that 600-700 point rally in the Dow, and sort of in the middle of the range here. So not much you can infer from the volatility, other than if we can take out this green line here, which is the moving average, most likely you would be in rally mode. On the other hand, this thing can easily roll over and start its decline. So take a look at that as well. In terms of another thing to watch as a clue, you put all the evidence together, is junk debt. I had pointed this out a while ago. This is a weekly chart on junk debt. Key level here is that 10-day moving average, which is sharply declining. And as you can see, you would really want to move over 39.20. That would really take out the last 4 to 5 weeks of work, including this pause week here as it just stopped before this massive drop. So if we could take out those highs and the low of that key pivotal week, we can definitely see a nice rally. That would probably coincide with a rally in the oil markets as well. So one other thing to consider in looking at the overall picture. Number one, let's just take a look at, as we're looking at the different parts of the yield curve and different types of debt, let's take a look at the weekly chart on the TLTs, which is the 20-year bonds. And believe it or not, this close of Friday is the highest weekly close even since the financial panic and crisis in 2008. Now, clearly, money is looking for safety. They're moving to our bonds, our currency, our stocks as well. But this is definitely a unique scenario where you have an extremely strong dollar, extremely strong bonds, and extremely strong stocks. Definitely a weird scenario. Let's take a look also at commodities, DBC. And you can see commodities at lows not seen since 2009, and really since this ETF, this is the lowest for ag commodities that has been recorded. Definitely deflationary. All right, not really a good sign for the global economy. So there's definitely some cross currents in the air as our U.S. equities sits at new highs. So you got bonds, U.S. bonds sitting at all-time highs, looking to go probably much higher. The other thing is that the amount of professionals short U.S. bonds is at record levels. So this is not consistent with a blow-off top. So it would be generally the reverse. Huge speculative buying at all-time highs would mean the trade is crowded. So the hedge fund players, the big players, betting wrong on bonds. Meanwhile, money continues to pour into that sector. Let's take a look at gold. Another reason why we're a little bit more cautious. Now that's GDX. You can see GDX bouncing off pretty much this is gold miners off of long-term weekly lows going back to the beginning of this ETF as well, 2009. We moved above the longer-term moving average on this chart, which is a 20-week moving average, or equivalent to about the 100-day as well. So you can see moving nicely off of those lows. Interesting. Taking a look at gold, similar pattern. Hold on, let me format this window a little bit better here. Okay, so what's most interesting in the gold chart here is if we zero in on the gold chart, you can see critical levels were taken out around that 115, 116 level. So you got a pretty good washout. And now we're trading above this moving average and really against this key pivotal point, which is where the flush occurred. So basically, most diehard bulls really gave up against these lows where you can see that line is put in, and now we're trading above it along with taking out that 20-week moving average, which again equivalent to about the 100-day or so. So that's it's an interesting moving average to watch, and we're definitely trading above it. We need to stay above 114.50, 114.77 level in GLD to keep this potential reversal intact. So with bonds flying, gold rallying, and the market sort of in high volatility state, it definitely is cause for some caution. And again, you can see that you're going back to the S&P chart, that you're flipping around that key 50-day moving average or so and the last 2 days of price action. So there is your setup. We looked at volatility, and I think that's pretty good coverage. One last thing you might want to take a look at also is the Russian stock market as another good potential lead indicator. So far, still under pressure, pretty much against the, not that far off the all-time lows. And again, we really need to see some more action. Potentially, if we can get above 1790.18, which is a pretty good size rally from here, that would probably indicate at least a short-term nervousness about whatever is the outcome from the pressure from NATO on the Ukraine versus what Putin wants to do might be abating. So that's a pretty good overall macro picture. Hope you enjoyed this. See you next week. Stay frosty because the markets are volatile. Either keep your stops really tight and let your profits run for very quick trades, or really widen them out to allow yourself to weather any volatility. What you don't want to do is be somewhere in the middle and just get chopped up based on this volatile market action. Thanks. Bye for now, and see you next week.